Hey guys, it's C. Ragnar, and we're back with episode 2 of the series Don'ts when you're applying for a mortgage. In the last video, we covered the don'ts that you don't want to do when it comes to credit. In this video, we're going to talk about the don'ts that you don't want to do when it comes to income. And definitely stay tuned for our third video, which is the don'ts when it comes to assets, meaning your checking, savings, 401k, retirement, all that good stuff. But for now, let's go ahead and address the don'ts when it comes to your income. And once again, we have Ragnar here that's going to go over some don'ts. And, we're also going to share some stories that we've encountered over the years with a wacky income situation. So Ragnar, go ahead and take it away.
Income, kind of like credit, right? The theme is usually change is good, and we hope change is for the better. But yeah, when it comes to mortgages and qualifying for mortgages in general, change for the most part can be a bad thing, a negative effect. So when it comes to income, don't go from full-time to part-time. That's a negative change.
Yep.
On that note, if you're paid hourly, don't reduce your hours, nor like in the case of nurses, medical professionals, perhaps some trade professions like electricians, don't lower or lessen your shifts, right? Yeah. So you typically work 3 shifts or 4 shifts, but instead you're tired, you're excited, so you want to go house shopping, and so you work 2 shifts. Don't do that.
Yeah.
Don't change from W-2 to 1099.
Yeah.
Okay, that's a big one. So when it comes to qualifications, right? W-2, if you're hourly or salary, it's you have the qualification for those who are W-2 it's simple, right? It's the average hours you've worked based on your hourly pay, or if it's a fixed annual salary. It's easy to calculate. When you go to 1099, however, it's not that it's more difficult to calculate or qualify that income. It's more so of the unknown. Let me explain. So when you're 1099, in the world of mortgage, you're technically self-employed. And for anyone who's self-employed, we all know you got to file tax returns, business tax returns, right? You're going to incur a P&L, a profit and loss. So here's your 1099 for X amount, $100,000. But because you're 1099, you now get to write off expenses,
yes,
right? Gas, food, entertainment, licensing, education, material, supplies, etc., etc. And when it comes to file your taxes in the beginning of the year, we get really excited when we're business owners because we know we get to write off as much as we want. Well, to a degree.
Yeah.
But the point is, and intent is, right, you want to minimize your tax liability. And so you take that $100,000 1099 income you earn, and regardless of how much you actually kept, when it comes to reporting on your taxes, because you want to deduct everything out and minimize what you pay Uncle Sam, your net income now, that bottom line is as minimal as possible.
Absolutely.
Right? But guess what, when it comes to mortgage, that's the number we're going to use to qualify you. Not your top number, the 100,000, the gross 1099 number, but the bottom number. So it's very important. And that's why when you go from W-2 to 1099, either you're going to have to wait 2 years and file tax returns. Now, I do want to note that there are loan programs that will allow this. If you switch from W-2 to 1099, there are loan programs that will allow you to still qualify, but that's for another topic. Okay?
And that's a great point. So in case you are one of the people that are doing the don'ts that we're talking about here, there still maybe a lifeline, so don't completely give up hope. For the most part, these are things that you want to typically avoid.
Correct. Yeah.
And I know for a lot of sales type of positions, a lot of employers will give you the option of becoming W-2 or 1099. If you're planning on buying a home and you're taking on this new adventure with a new employer, make sure you go W-2.
Yeah.
Just simply, if you go 1099 and without sufficient seasoning, that income may not be usable, regardless of how much you earn.
Yeah, and generally it is a 2-year seasoning requirement, 24 months, or 2 years tax returns, even if you might fall short of 24 months. Yeah, I had a case where as a dentist was W-2'd for X amount of years, and just around the time that they were interested in purchasing a home, she went 1099. And conventionally, unfortunately, we can't help that profession out now, that borrower. Because we don't know what their net income is. Because now you're not classified as a W-2'd employee, you're now considered or categorized as self-employed. And once you're categorized self-employed, we have to work off of tax returns, business tax returns. And for this recently converted 1099 employee, she doesn't have 1099 or tax returns. So we could not qualify her through the conventional route. Now, in her case specifically, because she's a dentist, there was a non-QM program that we were able to qualify her through. But that's for another video and probably discussion covering non-QMs. But for the purposes of this episode here, right, when it comes to income, don't change. If you're going to change jobs, okay, you're moving from one company to another, we're not saying don't do it, but do consult with your loan officer first. Because just to keep it very simple, regardless of how much you made in the past, okay, if you change jobs, it's going to primarily be based off of your job offer letter.
Yes.
Yeah.
Yes.
You might have all these incentives built in, like performance-based bonuses, et cetera, we may not be able to use that. There's no guarantee of that, nor if it's you're expecting to get a lot of overtime. Variable income is not going to be as easily or automatically qualified and used if you make a job change.
Of course,
okay?
Of course. And on top of that too,
Yes.
if you do make a job change, which I don't know why anybody would during a mortgage transaction or if you're planning to buy a home. But, more importantly, stay within your profession. If you've been a mechanic for the last 10 years and you're working for ABC Mechanics and you don't want to work with them anymore, go work for XYZ Mechanics. Don't go from a mechanic to a barista. Because that change in profession indicates that there's instability in not only your profession, but more likely in your income. And if we get a picky underwriter, they could definitely pick that out and call it out, and they just may not like it.
When it comes to variable income, so commissions, overtime, bonuses, typically 2 years is required. Okay? You have to show a 2-year history of receiving those type of variable incomes.
Yes.
And it will be averaged out. That's the key. And so, again, don't lessen your hours or don't lessen the commission. I know that's sometimes out of your hands, but just know that if you go into, pre-approval stage or into escrow and your variable income drastically decreases, it can alter your qualification.
Absolutely.
Yeah.
Right? Let's just say in 2023 you earn $50,000 in commission, right, on top of your base salary.
Yep.
And we need to explore your commission, your variable income to qualify you because your base isn't enough. Now, 2023 you earn 50, in 2024 you earn 100. Obviously, when you and I have a conversation during the buyer's consultation, when I ask you if there's going to be any commission income, you're going to tell me 100,000. But the truth is, it's not going to be 100,000 because we have to average out the last 2 years.
Yep.
So keep that in mind. Your latest and greatest may not be the income that we're utilizing.
And let's elaborate on that. Let's just take it a step further.
Okay.
Let's just say 2020, 2 years ago was 50, last year was 100,000. And let's say that you met with your loan officer and you were doing it, let's just say it was halfway into the year and you did 50. Okay, so you're on track to do another 100. And let's say you got pre-approved then. But let's just say that 3 months have passed since that pre-approval. And let's say that you didn't earn a single dollar more 3 months later. Well, guess what? That 3 months later, so 9 months into the year now, the loan officer will request updated payment statements and they'll ask for the commissions, and if it shows that right at the 9 month mark it's still 50,000, now that rate of commissions per year to date is lower than 100,000.
Yes.
So it's going to reduce your qualified income that's going to be used. Yes. So that's what I mean by just know, I know we don't have control over how much commission we can earn usually, but or sometimes, but just know that if it decreases over time, especially in as you're getting pre-approved, it can hurt your qualification amount.
I think a good rule of thumb is even those of you who are researching online on how to calculate debt to income, I think it's a good rule of thumb to try to qualify yourself based on your base salary without any other variables.
That's a great one.
The variables would just be the icing on the cake, help you with more affordability and lower debt to income ratio.
Yeah.
But for the sake of you trying to calculate something at home, just go off your base income. Yeah. Take your yearly salary, divide that by 12, and that's good enough. All right, that's a wrap for the don'ts of income, but do stay tuned for our next episode, which we talk about the don'ts of assets. We'll see you in the next one.
See you guys.